So why do bonds go up and down? Well, the obvious answer is supply and demand. If there are more buyers for a bond, the price of a bond will go up. And if there are more sellers, the price of the bond will go down. But there's more to it than just supply and demand. Bonds are also inextricably linked to the interest rates offered when the bond was issued. So bonds have a principal value, a coupon rate or the interest rate, and a time to maturity. So let's look at an example here. Let's say in January 2012, we bought a $1,000 bond with an interest rate of 4% payable quarterly. And this bond has a maturity of 10 years. So you'd receive a 4% per annum interest payment every quarter. And then after 10 years, in Jan 2022, you'd receive your principal amount of $1,000 back to you. This is the most simplistic explanation of how a treasury bond might work. So the key to remember here is that the coupon rates or the interest rates set on the bond is fixed at the time of issuance, and this does not change thereafter until it matures. But bonds are also traded in the secondary market every day, and the trading price of bonds moves constantly. So why does this happen? This happens because bond prices are governed by two types of risks. One is the risks in changing interest rates, and two is credit risk. So let's look at interest rates first. Movement of interest rates will impact bond prices negatively or positively. So to understand this phenomenon, let's use the above example of the 10-year bond issued in Jan 2012, which had a coupon rate of 4%. And this bond is due for maturity in 2022. Now, if in Feb of 2012, which is the next month, let's say the interest rates suddenly went up to 5% for whatever reason, then any new bonds issued in Feb 2012 would have a coupon rate of 5% because investors who are at the auction are demanding more return for their investment. Now, why did the interest rates go up? We look at that later. We just assume it went up for some reason. So now, if you wanted to sell your bond, which has a face value of 1,000 in Feb of 2012, do you think you'll get $1,000 for this bond? No. Only a fool would pay you $1,000 for a bond that yields a 4% return when the same investor can get the same $1,000 bond yielding 5% in the market now. So because interest rates went up, the bond you hold must go down in price. It'll go down in a proportional amount such that mathematically your bond and the new bond issued in Feb 2012 would have the same yield. That means you've lost money on your bond. But bear in mind, your bond loses value only temporarily. And if you hold it to maturity, which is in Jan 2022, you will receive the entire principal of $1,000 regardless of what bond prices are trading in 2022. So if interest rates go up, your bond value goes down. Perhaps your bond value, instead of $1,000, has now dropped to maybe $980 or so. But whatever, that calculation is done automatically by the bond market players, and the yield, the 4% yield on $980 or whatever your bond was trading for would technically be equal to 5% yield on $1,000. So that's how bond prices move up and down. So if interest rates go down, your bonds go up in value, and if interest rates go up, your bonds go down in value. The best way to understand this is to picture a seesaw. You put bond prices on one end of the seesaw and you put interest rates on the other side. And as one side goes up, the other side must come down. Similarly, if bond prices and interest rates function exactly like items on a seesaw. So the movement of the seesaw dictates the dynamics between the two. If one side goes down, the other side must go up.